you did everything right. You picked the one boring index fund everyone recommends, the one that owns a little piece of the 500 biggest companies in America, and you stopped checking it because that's what you were told smart money does. Here's what almost nobody tells you next. That fund isn't nearly as spread out as it looks, and the reason has a name. Picture a squirrel who thinks she's buried acorns across the whole forest, spreading the risk safe from any single disaster. Then one day she actually maps every hiding spot and finds that nearly 40% of her entire stash sits under just 10 trees. That's not a diversified forest anymore. That's a bet on 10 trees wearing a diversified costume. Penny already knows this one.
10 trees is not a forest. 10 trees is a really specific bet.
As of this year, the 10 largest companies in that boring index fund make up close to 38% of the entire thing, according to data tracked by RBC Wealth Management and reported by Forbes. One single company, Nvidia, accounts for roughly 7 cents of every dollar you put in. Back in the mid-2010s, the top 10 companies made up around 20% of the index. That number has nearly doubled in a decade, and almost every point of that increase traces back to one story: artificial intelligence. Here's why that matters more than it sounds like it should. Those companies aren't just popular. Markets are pricing them as if they'll collectively generate roughly $2 trillion in new revenue to justify what investors are already paying for them today, more than the combined 2024 revenue of several of them put together. That's not a criticism of the technology. It's a statement about how much of your safe, boring fund is quietly riding on one bet paying off exactly as expected. You might think the fix is simple. Switch to a version of the fund that owns all 500 companies in equal amounts instead of weighting by size. And that does fix the concentration problem, but it creates a different one. An equal weight fund has to keep selling its winners to buy more of its losers just to stay balanced, which means more trading, more cost, and a strategy that structurally works against whatever is currently succeeding. The standard fund weighted by size trades far less often because it just lets winners take up more room naturally. Less concentration risk on one side, more trading drag, and a bias against your own winners on the other. Neither option is free. You're choosing which risk you'd rather carry. So here's a different question. What if the next 20 years of returns don't come from the United States at all? It sounds unlikely, given how completely American markets have dominated the last decade and a half. But economists Elroy Dimson, Paul Marsh, and Mike Staunton have spent decades tracking exactly this in their Global Investment Returns Yearbook, and their data tells an uncomfortable story. In 1900, Britain commanded roughly a quarter of the entire world's stock market value, and London was considered the permanent financial capital of the world. Investors at the time saw no reason to look anywhere else. That dominance didn't last the century. Japan told the same story in the late 1980s when its companies looked unstoppable and the United States looked finished. The one honest lesson sitting inside 100 years of market data is that no country holds the top spot forever, and betting everything on the current leader has never once been the safe choice it felt like at the time. That's the case for owning some of your money in a global fund, one that includes companies outside your fund's home country entirely, the ones your boring index quietly leaves out just because of where their headquarters happen to sit. You're not betting against your own country's fund. You're refusing to bet the whole forest on one tree, no matter how tall it currently is. Penny doesn't bury every nut under the tallest tree either.
Tallest trees fall too.
Now, the part almost nobody expects: gold. For most of the last few decades, central banks treated gold as a backup asset, something you hold a little of and mostly ignore. That's changed fast. Gold has overtaken U.S. government bonds as the largest reserve asset held by the world's central banks, the first time that's happened since 1996. Part of the reason is technical but important. Under the newest global banking rules, known as Basel III, physical gold was reclassified in 2025 as a full Tier 1 asset, meaning banks can now count it at its complete value the same way they count cash, rather than discounting it the way they used to. When the rules governing trillions of dollars of institutional money change, institutional buying tends to follow, and it has. None of this means panic and convert everything to bars of metal. It means treating gold the way institutions increasingly do, as a small, deliberate slice of the portfolio, not the whole thing, and not none of it either. It also isn't a bet against the technology itself. Somewhere between the crowded trade, 10 companies everyone already owns through the same fund, and the boring, ignored corner of the market nobody's paying attention to, there's a quieter opportunity. Smaller companies that don't need to win the entire artificial intelligence race, they just need to use the technology well enough to cut their own costs or serve customers faster than they could before. When a tool becomes good enough and common enough that everyone has access to roughly the same version of it, the advantage stops belonging to whoever spent the most building it and starts belonging to whoever applies it the smartest. That's usually not the company already worth trillions. It's the one nobody's watching yet. The last piece is the one that gets ignored the most because it isn't exciting. Cash. Warren Buffett, arguably the most successful long-term investor alive, is currently sitting on a record cash position north of $390 billion, according to Berkshire Hathaway's own filings this year. He's not doing that because he's given up on markets. He's doing it because he's a value investor, and right now, by his own measure, there's a shortage of things worth buying at a fair price. Holding cash isn't the absence of a strategy. It's patience with a purpose, and it's also what lets you buy more of everything else at a discount the next time the market drops, which it eventually always does. Here's the actual takeaway, and it isn't sell your index fund. The boring fund still deserves to be the biggest piece of your plan because it still captured extraordinary growth, concentration, and all. But if a third of that fund's fate rides on a handful of companies delivering on an unprecedented bet, spreading a slice of your money into global markets, a small position in gold, and enough cash to stay calm when things drop, isn't fear. It's exactly what the squirrel does after she finally counts her acorns and realizes 10 trees were never a forest. Penny wants the last word on this one.
Counting your acorns isn't paranoia, it's the whole job.
So no, the index fund you were told to buy and forget wasn't wrong. It just was never as spread out as it looked. Knowing the difference is the whole point.